Welcome to a brand new explainer right here on the GAAP Advisors Ind AS Clinic. I am absolutely thrilled to have you joining us today as we put on our financial detective hats. We're going to uncover exactly why a deep, solid understanding of accounting standards is absolutely crucial for anyone, and I mean anyone, investing their hard-earned money in the shares of a listed company. Now, before we really get into the weeds, I do need to quickly mention that the views expressed in this explainer are the personal views of the author and are not binding on the audience. We always request that you seek the help of an expert before taking or refraining from any action based on the views we discuss here. Oh, and by the way, the brilliant breakdown we're exploring today was actually featured in the 210th edition of the GAAP Advisors Task Weekly newsletter, authored by CA Manish C. Iyer, director at GAAP Advisors. They've published over 230 editions on LinkedIn to date, so if you're on LinkedIn, I highly recommend subscribing to that newsletter for free. All right, let's get started on this fascinating case study. Okay, so let's kick off our investigation with a seemingly simple question. It's a question that really challenges the gap between what a company reports and what the standard rules actually dictate. Does defined contribution really mean zero future liability? You see, when you are putting your hard-earned money into a company, you rely heavily on their financial statements to make your buying, holding, or selling decisions. If a company labels an employee benefit as a defined contribution, well, you as an investor naturally assume there's no hidden baggage, no future cash drain waiting to jump out and surprise you. But is that actually always the case? Let's find out. Section 1. The Investor's Magnifying Glass. Examining the evidence. So we are looking at a real-world example here, drawn directly from the published Ind AS financial statements of a listed company. These were downloaded and independently reviewed by GAAP Advisors on a suo motu basis. Let's look at the financial figures sitting right out there in the open. The highlighted text shows an amount of 12.90 crore recognized as an expense for the year. Now, just a quick aside to set the stage. Our reporting period here runs from the 1st of April, the beginning of the period, right through to the 31st of March. And that 12.90 crore figure? That's in Indian rupees, which serves as both our functional and presentation currency. Just remember, any currency that is not this functional currency is strictly treated as a foreign currency. Anyway, back to the note. This massive expense is nestled comfortably right under the explicit heading 36.1 Defined Contribution Plans. As an investor who is maybe quickly scanning the balance sheet and notes, you'd probably mentally check this off as a closed, fixed expense with absolutely no future strings attached. Moving on to Section 2. The company's claim, the illusion versus the reality gap. Right, so this is where being a careful reader pays off immensely. A surface-level skim tells you one thing, but if we take our magnifying glass to the fine print in this exact same note, a really fascinating and highly critical internal contradiction begins to pop up. On one side, we see the company's bold estimate. They say, the company estimates that no liability will arise in this regard in the near future, and hence no further provision is considered necessary. Okay, sounds totally safe, right? But wait, look at what they say literally in the exact same paragraph. The trust has to ensure a minimum rate of return. However, any shortfall for payment of interest to members as per specified rate of return has to be compensated by the company. So they are freely admitting that if the trust's investments don't generate enough to meet the government-specified minimum return, the company has to reach into its own pockets to make up the difference. Which brings us to Section 3, the Ind AS 19 Rulebook, defining the terms. In accounting, as we all know, words have very strict, clearly defined meanings. To test the company's claim that this is merely a defined contribution plan, we've got to pull out the official rulebook. Paragraph 8 of Ind AS 19 explicitly defines defined contribution plans as post-employment benefit plans under which an entity pays fixed contributions into a separate fund and, here's the kicker, will have no legal or constructive obligation to pay further contributions if the fund doesn't hold sufficient assets. Read that carefully. You pay your fixed amount and you wash your hands of it. There is absolutely zero legal or constructive obligation to top it up if the fund underperforms. The risk falls entirely on the employee, not the employer. Now let's flip it and look at the other side of the coin. Paragraph 8 of Ind AS 19 goes on to define defined benefit plans. And honestly, it is one of the simplest definitions in the whole book. It just says, defined benefit plans are post-employment benefit plans other than defined contribution plans. It's a binary test. It's either one or the other. If a plan fails even a single criterion of a defined contribution plan, it automatically defaults to being a defined benefit plan. And that means the accounting treatment, the disclosures, and the liability recognition completely change. Let's hit Section 4, the hidden liability verdict, testing the setup. Okay, let's jump into the analysis and see how this all builds toward our final verdict. We are going to matrix the company's Provident Fund setup, exactly as described in their own words, directly against the strict criteria of the Ind AS 19 standard we just went over. By mapping their words against the standard, the reality becomes, well, painfully clear. Do they make a fixed contribution? Yep. But is there a guaranteed minimum return? Yes, as specified by the government of India. And crucially, does the company compensate for any shortfall? Yes, they literally explicitly state they do. Therefore, does this setup meet the no further obligation test required for a defined contribution plan? Absolutely not. No way. Compensating for an interest shortfall means the employer retains the investment risk. If the market crashes, the company's liability goes right up. It completely fails the defined contribution test. And that brings us to our verdict. The obligation to pay further contributions clearly exists. Therefore, it fails the defined contribution criteria and is actually a defined benefit plan. The way it's been disclosed reveals a perceived non-compliance with Ind AS 19. This is massive. Misclassifying a defined benefit plan as a defined contribution plan can seriously skew an investor's understanding of the company's true financial health and its future liabilities. If you happen to invest in a listed company's shares, a review of the company's financial statements for Ind AS compliance can really help you make a proper informed decision on buying, holding, or selling those shares. And actually, this is exactly why getting your financial statements reviewed by GAAP advisors before signing them is such a smart move. You can easily submit your financial statements in a near-to-publishing PDF format by email to info@gapadvisors.com. Which leaves us with this final provocative thought. If a defined benefit plan is hiding right there in the defined contributions node, what other liabilities might be hiding in plain sight on the balance sheet? Rigorous scrutiny of financial statements is just absolutely essential. Now, if this case study sparked your curiosity, you definitely need to check out the issue repository on GAPadvisors.com. It hosts over 4,500 issues and their detailed responses on Ind AS and Indian GAAP. Any person can register for free and submit issues for a detailed response delivered directly to their registered email inbox. This is extremely helpful, particularly for an auditor who needs to document exactly how they addressed any issue regarding the application of Ind AS. Plus, if you need personalized help, you can book a one-on-one consultation regarding your issues on Ind AS and IFRS directly with the author, CA Manish Seer, from his page on topmate.io. Thank you so much for your time today. I'd love to request that you follow or subscribe to the GAAP Advisors Ind AS Clinic Explainers on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to your explainers on. And finally, please do share this explainer among your contacts, your colleagues, your audit and finance teams, and especially students pursuing their CA course. Let's work together to spread the knowledge of Indian accounting standards. Keep learning, keep analyzing, and I'll catch you in the next explainer.